Welcome, everyone. It is the 10th of January. My name is Christopher Aaron, and I am honored to have you with me as we look at the gold, silver markets. In addition, this week we're going to be looking at the oil market as the two are very closely related at certain times. And next week we'll be getting back into some other currencies. We'll be looking at gold and silver and the Australian dollar next week. I want to remind everyone what a critical time period you are living through. I think this is very easy to forget sometimes with the ups and downs of the markets, the busyness of our lives. We live at a time in which not a single currency in the world has any tangible backing whatsoever. Now, this is the first time that this has ever happened. And when we look back in history, there is a pattern that we can observe of every single instance of fiat currency eventually reaching its intrinsic value, which is zero. So that leaves how many currencies that have lasted throughout history? None. Now, the challenging part for us as investors is to say, yes, those are the fundamentals. However, the market being the sum of all the individuals who are participating, the market may simply not care. Until when? The short answer is until it does. So we are living through one of those time periods right now, and it's really important that we keep in mind the historical backdrop of the unprecedented experiment that we're living through, while at the same time we keep a very close eye on what the actual market is telling us. Sometimes the fundamentals are simply glossed over for a period of time. And we want to try to determine when the fundamentals are going to come back into play. Thank you for being with me. We're going to look at something a little bit different before we get into the action for gold and silver. Oil related to gold. How many barrels of oil can you buy for 1 ounce of gold? Looking throughout the last 70 years, there's some very wild fluctuations here. Up, down, up, down, up, down. Quite sporadically. There's not a whole lot we can say about these trends except for the following 2 points. One, there is an area of long-term support somewhere here in the 6 barrel of oil for 1 ounce of gold range. And there's long-term resistance somewhere here in the 30 range. So what this means is basically every time that the price of oil gets too high, the top of this would be too low relative to the price of gold, there is a revaluation of the two commodities. Conversely, every time the price of oil gets too high, like in 2008, there is a revaluation of gold higher. So where do we find ourselves today? Right here at the upper end of the range. So if this range is going to stay valid, which we have to at this point assume that it is, we have to say that one of the following is going to happen fairly soon. Either A, the price of oil is going to rise, B, the price of gold is going to fall, C, the price of oil is going to rise and gold is going to rise, but not as fast, or D, they are both going to fall, with gold falling more than oil. So I do like to bring these sorts of charts to your attention. As you know, I don't sell gold or silver. I try to bring the most clear analysis on what's actually happening in the markets. And right now, oil is very cheap relative to gold. Is it possible that this 70-year range between roughly 6 and 32 could change? For example, could this range get up to 40, 50, or 60 barrels of oil for 1 ounce of gold? I can imagine a possibility that that would happen. What would be the fundamental backdrop for that? Well, what's been happening in the energy markets? There have been advances in solar technology. There has been a whole glut of shale oil that has come onto the market from the Canadian tar sands, for example. We have significant advances in other sorts of clean energy, geothermal, wind. Up in the region where I live in New England, you can drive up to Maine and you'll see miles and miles of windmills right along the Canadian border. So is it possible that oil could be valued lower than gold than the historic precedent? Yes, I believe that is possible, but probably not quite yet. Let's flip over to look at the chart for oil, the price of a barrel of oil, over the last 30 some odd years. It's very interesting to see how this commodity compares to gold and silver. The previous high for oil was somewhere here in this range of $35 to $40 a barrel. This was hit. This peak here represents the time from the first Gulf War in the early 90s. This peak was hit back in the 80s as well. The price of oil languished for about a decade before hitting this peak again in 2001, again in 2003, before finally breaking out and reaching all the way up to $147 a barrel. Then we had the crash of 2008. We had a rebound out of the crash and subsequently falling down again to the level of the crash. So what's going on here? The first important thing to notice with oil is that this level here between mid-30s and 40, which acted as 25 plus year resistance, also acted as support during the crash. And it's my belief that this level is going to act as support again. I do not believe the price of oil is going to fall significantly lower from where it is. Could it fall another few dollars per barrel? Yeah. Could it make a spike lower below this resistance, now turned support zone? Yes. But this zone right here is very, very important. This held the price of oil for, as I said, 25 years, and it should now act as support. You got to think about the mindset of people who were watching the price up at 147, and then 6 months later in the crash of 2008 were able to buy that same oil for only $35 a barrel. What made people step in at this price and say, it's time to buy? Are these entities going to sit by now that the price has reached this level again and not buy some more? I highly doubt it. Now, a couple of other things to bring to your attention on this chart. Look at what happened here, this short-term uptrend line that was forming here in 2010, 11, 12, 13, And look at what happened when it broke in 2014. Boom, waterfall decline. So this is why I watch these trend lines, because when significant ones break, it tends to lead to a significant move. What other significant trend line has just broken is the very long-term trend line dating all the way back from 1999. So there is something really unhealthy about the oil market right now. The price has actually broken below, just briefly this last week, below the price from the crash. If you look very closely here at the end of this chart, you'll see that spike down right where my mouse is. So I do expect the price of oil is going to stabilize. I do even expect that you might have a rebound of $5, $10, perhaps $20 a barrel over the course of the next year. But I don't think the price of oil is going to climb significantly back up anywhere to near where it was, at least in the next several years. When the price breaks below an important crash low, this is a very important indicator to pay attention to. Now, in the back of your mind, remember this. Remember the low from 2008 and pay attention to the low that is formed here in 2015, 2016. Compare this to the same 30-plus year chart for gold. What can we notice? The price of gold is significantly above the crash of 2008 level. After this same multi-decade consolidation and then breakout. So there is something happening to the monetary commodity of gold that is distinct from the energy commodity of oil. Let's compare this to silver. Of course, this being the range that we are looking for our final low in gold. Just having hit the top of that zone in green this last week. Looking at silver, again, the low that we're forming right now, still significantly higher than the 2008 crash low. Another way we can look at that is by checking again the performance versus the CRB commodity index, which includes oil, it includes natural gas, and a whole lot of other commodities. So we can see silver has been outperforming these other commodities for the last 10 years. This here, this low being above the 2008 low, is just another way of visualizing that when you compare that to the oil chart from 2 slides ago. So it looks to me as if we are forming some significant lows across the commodity complex right now. What is the other thing that we can notice about this chart here for silver? For example, compared to oil, which had a 25 plus year consolidation below the $40 level, silver has had a 35-year consolidation still ongoing below the $50 level. So when we view it from a real generational perspective, silver is actually still lagging oil. Silver is still where oil was when it was roughly $20, $25 a barrel, well below the high that had held it for many decades. So it's my belief that silver is going to play catch up over the course of the next 5 to 10 years and eventually exceed this $50 peak. So this should represent a massive opportunity for long-term accumulation, for long-term investors. Of course, we have to look at the short term as well, because like I said, the market can disagree with the fundamentals for a long period of time. Gold over the past few days has been fairly strong, closing finally back above the 1100 level. Silver, on the other hand, has been weaker. It tried to stay above 14 and then failed to do so, closing on Friday below 14 again. So we're seeing some underperformance by silver over the last few days, last few weeks. What's another way to look at that? Here, let's just look since the end of 2015. You can very clearly see gold in black and silver in blue. You can see the outperformance by gold here. So I just bring this to your attention so that everyone is aware. There are times where gold outperforms. There are times when silver will outperform. So if you're a silver investor, you have to expect this kind of thing, and you can't let it frustrate you. Especially because these moves are going to become more exaggerated. So, for example, gold might start rising over the course of a year, and silver stays within a range. So let's just keep this in the back of our minds as we go forward, watching this market unfold. Silver will eventually play catch up, and when it does so with a vengeance. Looking at gold over the last 6 months, there was that grinding low we had been paying attention to, finally closing above the double black resistance line, closing the week right around 105.5 on the GLD fund, which for anyone who's new, remember, I do not recommend you own this for the long run. This is okay for trading, but I simply use this because it allows me to produce clear charts in the 6-month time frame. So a nice break by gold here. Compare that to silver over 6 months, and we can see silver still being held in its range. Still kind of bumping along these lows. I've added a short-term pattern that I see materializing here in silver, which is a triangle. You can see by these dashed teal-colored lines, we've had this up, down, up, down, up, down, kind of converging here. It still wouldn't surprise me to see silver break down out of this triangle pattern at some point over the next week in the short run, especially if the stock market continues to be weak. Because as we know, silver can fall, especially with the stock market, if there is a crash. That will not affect the long-term performance. Backing this out, gold, just looking at the 2-year time frame again. Now I've actually updated some of these lines, and I just want to show you why, so you can start to understand my system a little bit. This is the chart as I had it a few days ago. We had this double black line here, which represented the bottom from the late part of 2014. And notice how significant this low was here. It hit this low right around 1140, bounced up, hit this low again, bounced up significantly higher, hit this low again in early 2015. A small bounce for the beginning part of the summer before finally breaking below this low. So this held the price for about a year. Notice what happened though as we formed this new low in 2015, and then the price rebounded above that previous resistance level, back below it, above it, below it, above it, and below it. So when we see this kind of action here, a previous important support and resistance level, when we see this kind of action by gold, by any commodity, where it just disregards the level, it trades above it and below it with no regard to that level, what we're seeing here is a change in the market. We're seeing that buyers and sellers are no longer caring about this 1140 level. So I let the market tell me what is happening, and I have to change my analysis at that point so we have a better idea of what to expect. So if this support and resistance level is no longer important to the market, here's how I've changed the analysis. So you can see those lines are gone. What levels now are important to the market? Well, this high that was hit right around 1180 back in October, and this low from July. This was the 1175 to 1185 low, which corresponded with the level that was hit multiple times here over the last 2 months. The struggle to break above this 1175 to 1185 corresponds to this low. So that's just a quick look, guys, at how I let the market tell me what it is doing, and I try to provide the best summary, the best trend analysis of what the market is actually saying. So we have this recent low here forming in gold, and now we're getting a bounce above this low right around that 1045 was the recent low, finally closing above 1075. So now we're going to watch this. This was a nice trade in here. If anyone was paying attention to those signals that were coming from the mining complex that I was talking about over the last few months, we had a good early warning signal here that perhaps gold was not going to move any lower. It did hold up right at the bottom end of this range, and now we're getting this bounce. So all we can say is let's see how far this bounce goes. Does it take us all the way up to the top end of this parallel trend line here? It very well may. This might correspond with this resistance level at around 1190 at some point when these two lines converge in the next couple of months. It might not get up all the way that far. We have to watch and see what the market tells us. When gold finally breaks above this downtrend right here, this is going to be a strong, strong indication that whichever the recent low was the final low for this bear market. And so yes, the price will be $100, $150 higher from where it was. But that's okay. We don't have to buy every single piece of gold at the absolute lows. If you're accumulating here in the lows and then you're accumulating some a little bit higher than the lows, that's okay. Especially when you have a perspective of where this market might go over the course of the next 5 to 10 years, which I expect will be significantly higher. Looking at silver, we're going to zoom in and then back out. So we're looking at this wedge pattern in silver, which I've been saying is a bottoming pattern. We actually have a series of embedded wedges forming here. So you can see this short-term wedge shown in the teal line matching the upper blue line. So we have this wedge pattern coming in, which tends to be a bottoming pattern. If we zoom this out, though, we can see this wedge pattern I was talking about here more clearly. But you can also see that based on the lows back from 2013, you have a much longer term wedge that's forming here. Now this looks, based on this perspective, like there could be, if the price were to break below this teal line, that there could be another significant drop. And I maintain open to that possibility. However, I want to tell you that the drop, should it break lower, will not be all that much more from what we've seen. It might be another $1, $1.50, $2 at the max. But when you zoom this out again and look at this wedge from the 5-year perspective, this is that same wedge we were looking at. You will see at how narrow this is actually getting now, and how much more significant the declines were that were forming at the earlier part of this decade compared to any remaining declines that may be ahead. So again, these breakouts from these wedge patterns tend to not happen much after the 3/4 point of the pattern. So this doesn't have to get all the way to the end of this converging wedge here. At some point here before that, I expect it to break. That could be this week. Who knows? That could be 6 months from now. I think this brings us up to speed on where we stand from the historic perspective